Morning, everybody. In the June webinar, we are looking at transition to IFRS 9 financial instruments. So you will remember that earlier in the year, we had 3-4 webinars focusing on IFRS 15. We are now starting a series of 3-4 webinars where we're going to focus on IFRS 9. And then towards the end of the year, a few webinars to focus on IFRS 16. So thank you very much for joining me today for this webinar. If we look at the outline of this webinar, what will we be covering? First of all, we will look at, are you ready for IFRS 9? And I've got a few polling questions. We will look at new categories of financial assets. And last year we had a whole 1-hour webinar on the new categories of financial assets. So we will do a bit of revision very quickly on those new categories of financial assets, a little bit of a recap. Because when we get to the transitional requirements in section 3, you need to be fairly familiar with the new categories of financial assets. We'll also go on and look at transitional requirements for financial assets that are debt instruments, and we'll look at financial assets with embedded derivatives. We're not looking at all the transitional requirements in IFRS 9, but I've just selected a few of them to get the conversation started. So are you ready for IFRS 9? I thought I should remind you, if you're a for-profit entity, IFRS 9 is applicable for years beginning on or after 1 January 2018. Therefore, if you've got a 30 June year end, it's 30 June next year, the first set of financials where you have to adopt AASB 9. And if you've got a 31 December year end, it's 31 December the current year, this current year, 31 December 2018. So I thought maybe it's a good time to just get an idea of our participants or our attendees. What is your year end? So I'll launch the first polling question. So what is your organization's year end? I've put in March because some attendees are based in New Zealand and a lot of New Zealand entities have a March year end. In Australia, traditionally, we've got June year ends. I know the banks and a few others have a September year end, and then December is quite often a fairly common year end for our not-for-profit clients. And then a few others have other. As you know, the requirements have relaxed a few years ago, and your year end does not necessarily have to be 30 June in Australia. And also sometimes you align your year end with the year end of your parent entity, which is overseas. So I just thought it would be interesting to see, if we look at our attendees, what are the year ends that we're dealing with. So 61% of you have voted. So I'll close it and I'll share the results. And there you'll see, yes, 75% of our attendees have a June year end. March, a small percentage, maybe those based in New Zealand. September, very low. And then December, quite a bit as well. So let's hide that and go back. So you can see AASB 9, if you've got a 30 June year end, 30 June 2018, you don't have to mandatorily adopt AASB 9. You can early adopt it. But what you do have to do for 30 June 2018 is you'll have to disclose the impact or the expected impact of AASB 9 on your organization. I thought let's look at another question. So maybe taking you to the other standards first. Have you started with a project to transition to IFRS 15 and or 16? I know a lot of clients that we're currently speaking to are doing a lot of work on IFRS 15. Because IFRS 15 has a similar or the same application date for for-profit entities as AASB 9 or IFRS 9. So a lot of people doing a lot of work on IFRS 15. And also, amazingly, the one that most people are excited about are IFRS 16. Now, maybe excited is the wrong word, not excited as in looking forward to it, but excited in the context, we have a lot of work to do. We have to get the information together. We have to disclose it to our users. So that's why I'm asking the question, are you focusing on IFRS 15 and 16 at the moment? I just wanted to get some idea where you're focusing your attention. So 51% of you have voted. Thank you very much for that. And if we look at the results, 46% not looking at IFRS 15 or 16 at the moment, 38%, and I expected a big percentage there, looking at IFRS 15 and 16, 16% not sure. So maybe the next question, I'm doing all the polling questions at the start here. So you've said to me, or you've indicated whether you've started with a project to transition to IFRS 15 or 16. What about IFRS 9? Now, I have to say my expectation is that not many people have really done a lot of work on IFRS 9. It seems to be that a lot of the attention is actually focused on IFRS 15 and or 16. But let's see. Let's get people to vote so we can see whether my hypothesis is right or wrong. I would love for me to be wrong, or my thinking to be wrong in this aspect. So we've got 45% of you voted. Please, if more people could vote so we can have comparable results to some degree. We're nearly at the 51% mark. If a few more of you could vote, that would be great. All right, fantastic. Thank you very much. So at this stage, 52% of our attendees have voted. And if we now close the voting, you will see that only 23% have started with a project to transition to IFRS 9. And the percentage for IFRS 15 or 16 was, I think, 46% on memory. So I think my hypothesis is still holding water. Now, my last polling question, and I promise you then I'm done with this, which of the following requirements of IFRS 9 do you expect will impact you? We've done webinars last year on the new classification and measurement rules. We've done a webinar on new impairment rules. We've done a webinar, and I think it was the December one, on hedge accounting. So which of these do you think will impact you, or let's put it, will most impact you? That would be interesting to see. In our client base and our attendees, I expected hedge accounting to not have a big impact. Again, that's just my guess. Let's see what the research tells us. Again, 43% of you have voted. Please, a few more to vote. I'm looking for at least 50% of participants to vote. Otherwise, I can't really put my hypothesis to the test then. All right, so fantastic. Yep, amazing. I'll close it. 51%, 52% of you have voted. Some people were fast there in the end. And 56% of you said that you expect the biggest impact to come from classification and measurement. 35% yes, the new impairment rules, and only 9% the new hedge accounting. Now, I've expected this, and based on this expectation, you'll see that the transitional requirements that I'm focusing on today in this webinar are around transitioning classification and measurement. So I want to deal with that, the most common one, which I've hoped for. Otherwise, I've completely missed the boat in my preparation, and we'll look at that. All right, so there you can see the results. So 56% the new classification and measurement, 35% impairment, and 9% hedge accounting. So let's hide that. I just want to make sure that I've hidden it, because as you know, if you're a regular attendee, I often forget to hide it. So I just want to double check that it's been hidden. Polls, it's all closed. It shouldn't be there. Why is it there? I'm still seeing it. Let's move on. All right. I just want to check. I've closed it. All right. I just want to ask you, if you look at the screen at the moment, are you still seeing the poll results? If you could just put it in the chat box for me, I would have hoped that you no longer see it. But if somebody could just let me know in the chat box, are you seeing the poll results, or have I moved on to a slide? Hopefully I have. Maybe it's in the question box. All right, so a few people are saying, we're still seeing the poll. I don't understand that. I've closed the poll. Surely that shouldn't be there anymore. Absolutely fascinating why it's there in the first place. Oh, beautiful. I don't know. I've been clicking about here. I hope I finally clicked all the right buttons. Anyway, you should now be seeing the 4 new accounting standards for not-for-profit entities. At least I've learned over the last 18 months, when I do these polls, sometimes I forget to switch the sharing off. At least I've remembered, at least I've checked. I'm a slow learner. It's taken me 18 months. So if we look at not-for-profit entities, they actually have 4 new accounting standards. And for not-for-profit entities, there's only one standard that is applicable for years beginning on or after 1 January 2018, and that is IFRS 9. So IFRS 15, AASB 1058, the Australia-specific one, and IFRS 16 a year later, years beginning on or after 1 January 2019. So I would have expected that not-for-profit entities, if they have a number of financial instruments, should have focused on AASB 9 to get ready. Looking at the not-for-profit entities that I'm dealing in our client base, I think the not-for-profit entities have been really proactive in looking at the implications of AASB 15 or 1058, as well as 16, and I'm not so sure about financial instruments. All right, so that's a bit of introduction. Now, the new categories of financial assets, and most of you have indicated that the categories of financial assets, or the classification and measurement aspects, are the aspects that you think would have the biggest impact on you. So if we look at the new categories of financial assets, IFRS 9 is saying the 4 categories are amortized cost, fair value through OCI, and that's only for equity instruments, so investments in shares, and no recycling would be allowed. There's also fair value through OCI for debt instruments, and recycling would be allowed. And then there's also fair value through profit and loss. So 4 new categories. The titles of the categories very descriptive of the actual accounting treatment within each category. Now, you'll also remember when we discussed this last year, we said in order to know in what category you end up, you first have to ask whether you've got a derivative, an equity instrument, or a debt instrument. So you've got a financial asset. The question is that financial asset a derivative? Is that financial asset an equity instrument, or is that financial asset a debt instrument? And then you have to use the appropriate decision tree. And you'll remember last year we've stepped through these decision trees, and we said if it's a derivative, so if your financial asset is a derivative, you'll always end up with fair value through profit and loss. And the reason is you're failing the SPPI test. If you've got an equity instrument, so investment in shares, You will fail the SPPI test. However, if it's held for trading, if those shares are held for trading, you have to use fair value through profit and loss. If it's not held for trading, you've got a choice. You've got an irrevocable election that you can make to either put it through fair value through profit and loss or to put it in fair value through OCI, and then no recycling would be allowed. So this would be financial assets that are equity instruments, and only two alternatives available if your financial asset is an equity instrument: fair value through profit and loss or fair value through OCI. If your financial asset is a debt instrument and it's including hybrid contracts, there are two key tests that you have to apply. And the first one is the SPPI test. Now, SPPI is solely for the purposes of principal and interest. You do that at an instrument level. If you fail it at an instrument level, you have to use fair value through profit and loss. If you pass it at an instrument level, the next hurdle to jump is the business model test, and you do that at an aggregate level. Now, if your business model is to hold to collect until you receive your contractual cash flows, that's right on the left of the slide, and you're not going to use the conditional fair value option, then you are allowed to use amortized cost. However, if your business model is a mixture of collecting contractual cash flows and selling financial assets, and you also reject the conditional fair value option, then you'll use fair value through OCI, but in this instance, recycling would be allowed. If your business model is neither of those two, you end up with fair value through profit and loss. So for financial assets that are debt instruments, it's quite a complex process. And if you look at debt instruments, it would include hybrid contracts. So that's all revision of what we already know, and just to make sure we know what we are transitioning to. So now we're getting to the transitioning bit. If we look at the transitional requirements, remember I said I'm going to focus on classification and measurement, which means these four categories of financial assets. The transitional requirements are structured that there are transitional requirements for classification and measurement, and they are applied retrospectively. There are transitional requirements around impairment that are applied retrospectively, and there are transitional requirements around hedge accounting that are applied prospectively, and there's a few exceptions to those. So transitional requirements for IFRS 9 are lengthy, very complex, and it depends on what particular area you're dealing with. And I've asked a polling question, and most of you have indicated you'll be impacted by the new classification and measurement rules, and that's what we focus on today. Now, the main principle, if we look at the IFRS 9 transitional approach, is that an entity has to apply all the requirements of IFRS 9 at the same time. Now, you might say, Aletta, why are you making a big deal of this? And the reason is IFRS 9 is the very first standard that I've ever seen that was issued piecemeal. So the first parts to IFRS 9 was issued years ago, soon after the global financial crisis. And the last parts around hedge accounting was only issued fairly recently. So it's taken them years to issue the new IFRS 9, and they've issued them in drips and drabs. And therefore, they've said, listen, at this stage, if you have ignored all the previous versions of IFRS 9, and you are now, for years beginning on or after 1 January 2018, deciding to adopt, because it's mandatory, and apply IFRS 9, you have to look at all the requirements. You can't pick and choose. There are three exceptions to that general principle. And the one exception is that the requirement to present excuse me, the requirement to present changes in fair value related to credit risk, and to present it in other comprehensive income for liabilities that's been designated at fair value through profit and loss, you can only adopt that particular requirement in isolation. If you look at your hedge accounting requirements, you do have an accounting policy choice to continue to apply the IAS 39 or the AASB 139 hedge accounting requirements. And then the third exception is that if you have previously adopted previous versions of IFRS 9, and I would say previous incomplete versions of IFRS 9 because it was issued piecemeal, there are special transitional provisions for those entities. So that's the general principle that we've got. Now, a concept that's important to understand whenever you look at transitional requirements, whether it's in IFRS 9, 15 or 16, is the concept around the date of initial application. And we refer to it as the DIA, date of initial application. Now, the date of initial application is defined as the beginning of the first reporting period in which an entity first applies IFRS 9. So, sorry, two examples. If an entity, it jumps, why are the slides jumping about? First example, bullet point 2. If an entity applies IFRS 9 for its annual reporting periods beginning on or after 1 January 2018, and that would be because your year end is 31 December 2018, your date of initial application would be 1 January 2018. However, in the third bullet point, the second example, if an entity applies IFRS 9 for its annual reporting periods beginning on 1 July 2018, the date of initial application would be 1 July 2018, and that would be because the first annual report will end 30 June 2019. So your date of initial application is the beginning or the first day of the first reporting period in which you apply IFRS 9. Now, this date of initial application is relevant to a number of assessments that relate to the classification and the measurement of financial assets. So it's important to understand this definition. If we look at the transition requirements around classification and measurement, for classification and measurement, the transition requirements have to be applied retrospectively. So basically, what does that mean? It means that you're not required to restate your comparatives for the new classification and measurement of financial assets. So you're not required to. However, you've got a choice. You could decide to restate the comparatives. Important is you have to disclose all the disclosures required by IFRS 7. As you know, financial instruments are covered in IFRS 9 and IFRS 7. IFRS 9 has the recognition and measurement, and IFRS 7 the disclosure aspects. So basically, if we look at that previous table slightly differently, we could say in a diagram or a decision tree, you've got an accounting policy choice to restate your comparatives, or you have an accounting policy state that you do not restate comparatives. And that's your decision, and you have to disclose that accounting policy choice. So a bit of information around no restatement and restatement, and I've tried to put them next to each other to get a bit of a comparison. So if we're not going to restate the comparatives, it means we'll be adjusting opening retained earnings at the date of initial application. And with what amount will we adjust opening retained earnings at the date of initial application? It will be the difference between the carrying amounts before the adoption of IFRS 7 and the new carrying amounts on the date of initial application. So you would have had your carrying amounts the end of the previous financial year, and then on the first day of the new year, you'll say, work out what the carrying amount should be in terms of the new standard, and that difference we adjust against opening retained earnings in our current year. So what about restatement? Now, restatement and to select that accounting policy is only available if you can apply or come up with the values, usually fair value, without using hindsight. So you cannot use hindsight to come up with fair values. And then also you restate for classification and measurement based on IFRS 9 transitional provisions at the date of initial application, and no restatement is permitted for financial assets and financial liabilities that are already derecognized at the date of initial application. So only those financial assets or liabilities that are still in existence, still on your balance sheet on the date of initial application, you can do a restatement for those. So let's look at a few examples to illustrate. Now I'll say this, you'll see that in the presentation slides that you would have received via email or that you could download from the handout section, I've not given you the suggested solutions to these examples. But this afternoon, when we send out a link to the recording of the webinar, we will also distribute the presenter slides with the suggested solutions, and the presenter slides with the suggested solution will also be uploaded onto our BDO website if you want to access it that way. So in example 1, entity A applies IFRS 9 with a date of initial application of 1 January 2018. Now on 30 September the previous year, entity A sold an available for sale equity investment, an AFS equity investment, and recognized a gain of $30. And that $30 included the effect of reclassifying the related amount from your available for sale reserve in OCI to profit or loss. So the question is, are there any adjustments required on transition? Any adjustments required on transition? Now, if you look at the solution to this one, no adjustments required, because the date of initial application is 1 January 2018, and IFRS 9 does not apply to financial instruments that have already been derecognized at the date of initial application. So if we move on and we look at example 2, now in this example, entity B bought an equity investment in an unlisted company on the 1st of January 2017 for $100. Now, the equity investment was measured at cost using IAS 39 or AASB 139. And on 31 December, the end of the previous year, entity B recognized an impairment loss of 60 on that equity investment. Now, entity B applies IFRS 9 for the very first time in the annual reporting period ending 31 December, and therefore your date of initial application is 1 January 2018. Now, it elects to measure the equity investment at fair value through OCI, because remember, for equity investments, if it's not held for trading, like this one, you can decide to carry that equity investment at fair value through profit and loss or fair value through OCI. Now, the fair value of the investment on the 1st of January 2018 is $50, and the fair value at the end of 2018 is $90. So the question is, how should entity B account for the investment on transition? And then also, how should entity B account for the investment at 31 December 2018? So those are the facts, and you'll have it in front of you. So let's look at the answer. So the date of initial application is of IFRS 9 is 1 January 2018. Now, the carrying value of this investment at the end of the previous year, we had this investment in the balance sheet at $40, original cost less impairment loss of 60. Now, the fair value under IFRS 9 on date of initial application 1 January is actually 50. So the carrying value, remember, they had it initially at cost, and then they said cost less impairment loss gave us 40. Now we are carrying it at fair value through OCI. Fair value is 50. So that difference of $10 have to be recognized in opening retained earnings at 1 January 2018. So your journal, your initial adjustment on the date of initial recognition is debit that equity investment, the financial asset, increase it with $10, and credit opening retained earnings. All right, because we're carrying it at fair value through OCI. So question is, how should we account for this investment? If they decided to elect to account for this equity investment at fair value through OCI. Sorry, I just want to say at the previous example, I just want to confirm. If you go back to example 2, in the background, it elects to measure the equity investment at fair value through profit and loss. The third last bullet point for example 2 should be, all right, sorry, we've got it at fair value through OCI. Our question is, first of all, transition, how do we do it? And then how do we do it 31 December 2018? Okay, if we go on and we'll say, all right, in example 3, we say, sorry, I've confused myself. In example 2, we are saying fair value through OCI. That's what we've said all along. I just wanted to confirm. In answer A, we're looking that what is the journal on transition. In answer B, we're looking at what is the journal at 31 December 2018. Now, 31 December 2018, we've said because we've elected to measure the equity investment at fair value through OCI, fair value at 31 December is 90, and therefore the change that should go to OCI is the difference between the 90 at the end of the year and the 50 on the 1st of January. And therefore, we're going to say debit equity investment and credit revaluation reserve with 40. So it's fair value through OCI, changes in fair value go through OCI. I think the interesting thing here is if you go back to our answer in A, the transitional requirements says on the date of initial application, even though you are now going to account for the investment at fair value through OCI, that journal on the date of initial recognition, 1 January 2018, you are fixing the value of the equity instrument. You are adjusting it from 40 to 50. And you are fixing it against opening retained earnings. Because remember, in the past, you would have expensed that impairment loss. And that's why we're fixing it against opening retained earnings. However, going forward, by the end of the year, we know changes in fair value going forward now have to sit in OCI. All right, let's look at example 3. Now, in example 3, we use the same facts as example 2, but we change one thing, and that is we now decide that when we adopt IFRS 9, we're going to classify the equity investments at fair value through profit and loss. So the same question really, how should we account for the investment on transition, and how should we account for the investment on 31 December 2018, the end of that first year? So the only difference is it's now a decision to account for this financial asset at fair value through profit and loss. So on the date of transition, a date of initial application, 1 January 2018, we're going to say the carrying value under the old standard on 31 December was 40. The fair value on the 1st of January is 50. We know we have to increase the equity investment by 10. So we debit equity investment and we credit opening retained earnings. So what you can see here is if you compare this answer to example 3A to the answer to example 2A, you can see the actual journal on the date of initial application is exactly the same, whether in future you're going to use fair value through profit and loss or fair value through OCI. The difference is in part B. Because here we've decided to account for the equity investment at fair value through profit and loss, it means at 31 December, we know there's a change of $40. It's gone from 50 to 90, and that change in $40, we're going to say debit the equity investment 40, and now we credit profit and loss. If you compare this answer with the answer to example 2B, the journal was slightly different because we said debit equity investment and we said credit revaluation reserve, which is part of OCI. So example 2 and 3 can be put next to each other to contrast and compare, treating your equity investment at fair value through profit and loss versus treating your equity investment at fair value through OCI. If we move on and we look at transitional requirements where your financial assets are debt instruments. So our previous example, our financial assets were equity instruments. Now we're looking at debt instruments. Remember, for debt instruments, you have two hurdles to jump in order to get to amortized cost. So the first hurdle was the SPPI test, and the second hurdle is your business model test, and we've put it in that decision tree. So if you look at the transitional requirements for financial assets that are debt instruments, there are different transitional requirements for the SPPI test, which you can see on this slide, or the business model test, which you can see on the next slide. All right, so different transitional requirements for the two different hurdles. So let's go back to the SPPI test, which is covered in IFRS 9, paragraph 7.2.3. I just want to take a sip of water for a second. That was 3 sips. All right. So the requirements, or an overview of the transitional requirements around the SPPI test is you apply the SPPI, which means solely for the purposes of principal and interest. You apply the SPPI contractual cash flow characteristics test based on facts and circumstances that exist on initial recognition. Your resulting classification is applied retrospectively. So you don't consider the facts and circumstances that existed in the previous year or previous years. You just say, to assess SPPI at the date of initial application or initial recognition, what are my SPPI? Is it solely for the purposes of principal and interest or not? It is then applied retrospectively. Now, you also have transitional requirements when it's impractical to assess a modified time value of money element. And you also have transitional requirements that are very specific if it's impractical to assess whether the fair value of a prepayment feature was insignificant. So for those two particular aspects, there are additional transitional requirements. I have warned you, transitional requirements for IFRS 9 are complex. And one could expect that because the requirements of IFRS 9 are complex. If we go on and we're still busy with classification and measurement, we're still looking at financial assets that are debt instruments, but now we're looking at the business model test. And in this instance, we are saying your business model assessment, which is either hold to collect or hold to collect and sell, or neither of those, that business model assessment is carried out at the date of initial application. And it will result in a classification that is applied retrospectively. So there's no adjustment for different business models that existed in prior periods or the prior period, the comparative year. So they've given us a date, the date of initial application. That is the date that you assess your business model. And if you look at your SPPI test, it is the date of initial recognition. All right, let's look at an example to illustrate this. So in example 4, and the requirements are captured in IFRS 9, paragraph 7.2.15. And you'll see IFRS 9 has a complex numbering system. It's not just paragraphs 1 to 100. They've got 7.1, 7.2, and it goes further and further, quite complex. So let's look at background. On the 1st of January 2016, Entity C lent developer company 500 million for 5 years at a fixed rate of 5%. And that 500 million, and the repayment is due on the 31st of December 2020. Now, the developer company uses the funds to buy a piece of land and construct residential apartments for sale. Now, in addition to that 5% fixed interest rate, Entity C will be entitled to 10% of the net profit from the project. Now, that's an important piece of information, because if you look at the SPPI test solely for the purposes of principal and interest, you can see that Entity C doesn't meet that test, because they're not only going to get the principal amount of 500 million back and interest of 5%, they're actually going to get a portion of the profit of the project. So they can't meet the SPPI test. So under IAS 39, Entity C had accounted for this loan as an available for sale financial asset measured at fair value through OCI, and remember, impairment losses, however, went to P&L. Entity C applies IFRS 9 for the first time in its annual reporting period ending 31 December 2018, and your fair value of the loan on the 1st of January 2018 is 490 million. And remember, 1 January 2018 is our date of initial application. And the fair value of the loan at the end of the year is 530 million. Now, questions. First of all, what adjustments are required on transition on 1 January 2018? And what is the journal entry for 31 December 2018, the end of that first year? So, question 1, what measurement adjustments are required on transition, if any? Now, under IFRS 9, the terms of this loan do not meet the SPPI test, and therefore they'll have to account for this loan at fair value through profit and loss. However, under IAS 39, the loan was accounted for as an available for sale financial asset, which means in the balance sheet it would have been at fair value. Changes in fair value would have gone to OCI if it's an increase, and if it was a decrease below, if it was a decrease, it would often end up, that takes that OCI into negative, it would often end up in P&L. Now, no measurement adjustments are required on transition. Why? Because under IAS 39, it was accounted for at fair value. Under IFRS 9, it will be accounted for at fair value, no measurement adjustments. Question B, however, what is the journal entry at the end of that year? Now, the journal entry at the end of the year says your financial asset now has a fair value of 530 million, and therefore we have to increase our financial asset with 40 million, and we credit profit and loss with 40 million. Remember, this asset doesn't meet the SPPI test. It now has to be accounted for at fair value through profit and loss. So important, we debit the financial asset at 40 million and we credit profit and loss 40 million. So this is just an example to illustrate if your financial asset is a debt instrument, how would the transitional requirements apply? Right. Now, I suppose for the hardest one we'll be looking at today, what about financial assets with embedded derivatives? Right, so a little bit of a recap. If you currently look at AASB 39 or AASB 139, it requires these hybrid instruments to be assessed to determine whether they should be separated into components or not. So it could be that you keep the whole hybrid together, or based on your assessment, you could potentially split the hybrid into the host contract and the embedded derivative and account for them separately. Now, IFRS 9 has changed these requirements and says if you've got hybrid instruments, you have to assess them in their entirety. And in many cases, hybrid instruments will just be measured at fair value through profit and loss. And you will use your IFRS 7 fair value disclosures to determine the host component's fair value in prior periods. Because currently your host component would not be accounted for at fair value if they are accounted for separately. However, the embedded derivative would always have been at fair value. So if we now have to take the whole combined instrument under IFRS 9 at fair value, how do we know what the fair value is? We had to disclose the fair value under IFRS 7, so we know what the fair value is. So we calculate the fair value of the total instrument at the date of initial application, and the difference between the total components and the fair value as a whole will be recorded for in retained earnings. So I think the best way to look at this is to look at an example. So in example 5, which is our final example for today, we've said Entity Z holds a hybrid instrument. It's originally been acquired in 2017. Now, at 31 December, the instrument was separated into the host contract and the embedded derivative. So the host contract was at amortized cost and the carrying value was 5 million. Your embedded derivative had a fair value of 200,000 at 31 December. And by the way, that host contract that had an amortized cost of 5 million, excuse me for a second. The host contract had a carrying value of 5 million, but we've disclosed in the financial statements that the fair value of that host contract was 5.5 million. The embedded derivative was always accounted for at fair value through profit and loss, and their fair value was 200,000. Your date of initial application of IFRS 9 is 1 January 2018. And if you determine the fair value of the whole instrument in its totality on the 1st of January 2018, the date of initial application, it's 5.75 million. So how should Entity Z measure the hybrid instrument at the date of initial application if your comparatives are restated versus your comparatives are not restated? So if we look at the two alternatives, so first of all, if we look at little a, so comparatives are restated. What we'll do in this instance, we'll say the fair value of the hybrid instrument at the end of the previous year, the host contract had a fair value of 5.5 million and the embedded derivative asset had a fair value of 200,000. Therefore, the fair value of the hybrid instrument on 31 December in totality was 5.7. And because we've decided to restate comparatives, it's important for us to make sure that our hybrid contract in our 31 December 2017 column is now reflected at 5.7 million. So our journal would be debit the hybrid contract, the 5.7, We will credit the host contract the carrying amount of 5 million. We'll credit the embedded derivative the 200,000, and you can see, because in the past your host contract was at carrying amount that's not fair value, there's an adjustment and there's an increase to opening retained earnings of 500,000. So this journal is just processed to make sure that when we restate the comparatives for 31 December, we will now actually have the hybrid contract at 31 December at 5.7 million. But as you can see, we can't go back into the previous year and make changes to items in retained earnings. We have to book it against opening retained earnings 1 January 2018. Important, your adjustment is against opening retained earnings at the date of initial application. You cannot go back into the previous year. And then also you'll calculate the difference between the fair value of the entire instrument and the fair value that we've now calculated in accordance with 7.2.6. So remember, we said on day 1 January 2018, the fair value of the hybrid instrument was 5,750. The fair value at the end of the year, 31 December, is 5.7. And now we're going to say the difference, the 50,000 difference, is we're booking towards opening retained earnings. Sorry, I just want to go back and show you the facts again. How should Entity Z measure the hybrid instrument at the date of initial application? So we're only at the date of initial application, and in the first one, comparatives are restated. So if you look at this journal, this opening retained earnings of 500,000 is opening retained earnings, and you'll disclose it as opening retained earnings 1 January 2017. However, the journal is actually processed on 1 January 2018. I think it's really important with these transitional requirements that people remember. You cannot open up last year's general ledger and process journals. The only thing you can do is process the journal on the 1st of January 2018. And what you can do then is you can restate comparatives when you disclose and prepare financial statements. So this 500,000 will be adjusted on the 1st of January 2018 against retained earnings on the 1st of January 2018. But when you disclose it, you're going to disclose it as an adjustment against opening retained earnings on 1 January 2017. If you look at this 50,000 adjustment, again, the journal is processed on the 1st of January, and the adjustment will be disclosed against opening retained earnings on the 1st of January 2018. So for transitional requirements, it's very important to distinguish between the date of the journal entry and the disclosure in the financial statements. If you look at B, how should Entity Z measure the hybrid instrument at the date of initial application if comparatives are not restated? Now, I just want to say this is a trick question because the measurement doesn't change. The hybrid instrument on the 1st of January 2018 is 5.75 million. So that is exactly the same as question A. The difference is, how do we disclose the adjustment of 550,000? In the previous example, example 5A, we disclosed 500,000 as an adjustment opening retained earnings 1 January 2017 and 50,000 as an adjustment opening retained earnings 1 January 2018. In this example, because we're not restating comparatives, the total adjustment of 550 will be disclosed against opening retained earnings 1 January 2018. So if you look at this journal on the 1st of January 2018, and you take this journal and you compare it with this journal for answer A, combined with this journal for answer A, you would see that the actual journal processed on the 1st of January 2018 is exactly the same journal. But in A, we've done it separate to make it quite clear how we'll disclose it in the financial statements. So please don't get the actual journal entry versus the disclosure in the financial statements mixed up. So that is our transitional requirements. I just wanted to use the opportunity to remind you that BDO has a technology solution to help you to implement IFRS 16. It's called BDO Lead. It is available on our website. So what's going on here? Everything is jumping around today. It seems as if I've got no control over my slides. So I just wanted, I'll go to the back now. I just wanted to remind you that for BDO Lead, we've got that lease management solution. You can find it on our website. If you want a demonstration, I've recorded a video demonstration. It's available on our website. Please contact me if you're interested in BDO Lead. It is beautiful, designed originally by BDO Germany, implemented at Deutsche Telekom, that has thousands of leases, as well as Aldi supermarkets in Germany and a number of other clients. If you need any assistance around transitioning to IFRS 9, we've got webinars. Next month's webinar is IFRS 9 risk assessment. Kevin Frobers will do that webinar. I'm actually going to Kuala Lumpur for some IFRS training at that date. If you're looking for advice, you can contact me in Melbourne or the national offices. You can contact Wayne in Perth, Kevin in Sydney, or Clark in Brisbane. We've got a big team, the biggest team outside the Big Four, and I actually think we give the size of the Big Four teams a very good go as well. So that's the team of people you might speak to. And I'll end by saying thank you very much for joining me today for this webinar. We'll send a link to the recording out this afternoon, and we'll also distribute the solutions to all the examples that we've discussed today. So thank you very much. Enjoy the rest of the day.